All right. Now, could it be 2008 all over again for China? Fitch Ratings is warning of an unprecedented credit bubble growing in the Chinese banking system. Ling Kent is here with that story. And, Joe, a lot of us have to pay attention to this. For instance, exports alone have grown dramatically from the United States to China. So we want to pay attention to this.
That's right. We really do. And what's interesting about this is it's kind of a self-engineered credit crisis. Now, basically, banks have become increasingly reliant on short-term funding to meet long-term obligations, and they're now finding themselves cut off from unfettered access to cheap money. So this sent shares into their steepest decline in a single day in nearly 4 years. Check out this chart. The Shanghai Composite tumbled 5.3% Monday on fears the People's Bank of China might not intervene to ease that credit crunch. And this is the statement that sent the Chinese market totally spiraling. The PBOC, People's Bank of China, posting this on their website. They say, due to many changing factors in the financial markets and also because of the mid-year point, the requirements for commercial banks in liquidity management have become higher. Now, this confirms the Chinese government is trying to come down very hard on the infamous shadow banking system. And here's the American investor impact. You can see the Dow is still slightly down today on nervousness on China, aside from obviously those Fed concerns. But this plus the uncertainty over China's growth slowing down, it's a tricky combination for companies heavily invested in China. And if the bank does not limit the strain that those big companies feel or the banks feel, this could trigger a significant and unpredictable, dangerous outcome.
Well, the Chinese have been there before.
They have been there before.
And, you know, when I talk about exports, I mean, exports from the United States last year, I think it was like 11% growth into China, whereas just in 2002 it was about 5%. So a slowdown manufacturing-wise could be really problematic, but there have been signals all along that we would get a correction in China. Yes. Gordon Chang is a guest on this show all the time.
He's always predicting the collapse of China. But what I think is the most interesting thing about that is that if you look at the extra yuan loans that have been given to the banks or to big companies or all these state-owned enterprises, the return on that investment, so to speak, that GDP return, has been diminishing dramatically over the past 4 years. So you saw like 0.85% of a return. Now you're seeing 0.15. And it's going down and down and down, which means they're getting used to the money and it's not producing what it should be, and it's propping it up so much that what is actually legitimate behind that investment.
All right. Well, Joe, I know we're going to pay attention to it because what happens in China, it impacts so many of our investments here. So thank you.
That's right. Thanks for having me.
It's good stuff. Okay.